Hello everyone. We're now going to start a sequence of videos on credit derivatives. As you will see, these are very interesting contracts that allow investors, banks and so on to either hedge their credit exposure or to do exactly the opposite, to speculate on credit risk. Okay. We are going to start with an overview of the market and the different types of contracts that we have. And then we will spend a fair amount of time looking at the most relevant derivative, which are credit default swaps. So we will see all the details about how they work, how they are used for hedging, for speculation, and then how they are priced. Okay? And then in the end, we'll speak a little bit about other credit derivatives that do not have such a large share of the market, but still have their own niche, their own market. Okay, so let's jump into it. Credit derivatives. I think that the easiest way to understand credit derivatives is to think of this as insurance. So the credit derivatives are essentially insurance against a default, or against, more specifically, against the deterioration in the credit quality of a specific firm, a specific issuer. Okay. So they serve the following purpose. So basically, a credit derivative, what it does is it isolates the credit risk from other types of risks, and then allows you to move this credit risk from one party to another counterparty. Right. So there are typically two types of agents in this market that may want to either reduce their credit exposure or increase their credit exposure. So, for example, for the first option, reduce credit exposure, you can think of a bank. So think, for example, of a commercial bank that has a large portfolio of credits of loans that they have given to their clients. Okay, if for some reason the bank does not want to get rid of those assets, to sell the assets, it can buy credit derivatives to eliminate or to reduce the exposure, the risk that it has on the balance sheet, right? So the bank will typically enter into the CDS as protection, not CDS, the credit derivative in general, as a protection buyer. Okay. On the other side, you may have investors that are unable to get those assets directly. So think, for example, of a hedge fund. Hedge fund cannot be in the business of giving loans to individuals or to small companies and so on. But the hedge fund may still want to take the credit risk and get the corresponding premium if things go well, right? So one way to get that exposure, to get the risk and hopefully get the premium, the corresponding premium, is through credit derivatives. So by selling credit derivatives. So think here like this would be the role of an insurance company, for example. They would be selling insurance. If everything goes well, they profit from the premiums. If things go well, they have to pay the losses that happen. Okay. So you'll see here on this side insurance companies, real insurance companies, hedge funds, like I said, private investors, and so on. Right? Okay, an important concept in these derivatives is what is called a credit event. So a credit event basically is what triggers the credit derivative. It is that event that defines that the insurance is the insurance the insurance becomes active. You can act on the insurance, right? So this has to be specified very clearly in the documents of the contract. Typical events that people write in the contract are what you have here. So this first one is the most extreme. There is a bankruptcy of the firm or liquidation of the firm. So it's basically the worst stage. Another alternative is something a little bit less severe, which is a failure to pay. So if the firm has some bond and it defaults on the coupon of that bond or on the principal of that bond, then that may trigger the credit derivative. for sovereigns, you typically have a different designation. You call it repudiation or moratorium. So typically, you don't say that the country defaults. They basically delay what they are supposed to pay, or they pay less, or something like that. So that may be specified also in one of these derivatives. A general term for all these changes is restructuring. So any change that the firm does to the terms of an existing loan will be enough to trigger the credit derivative. So this is usually done when a firm does this. It's something that is not good for the bondholders. So anything that changes what was agreed is considered a credit event. And you can have things that are different, like, for example, you can have a downgrade in the ratings, or you can have a corresponding increase in the credit spread. Okay, this is not so common, but these ones here are the more common types of credit events that are written in contracts. Okay. So a little bit of how the market looks like. The market started in the 90s, okay, and then it had a fast growth. So if you look at the notional outstanding in these contracts, you'd see a curve that is going up very quickly until the financial crisis. But then after the financial crisis, it has decreased a bit. Okay, in 2000, this was the distribution of the credit derivatives. So this is very old information, but the point here was to show that the market was split among these different types of derivatives: credit default swaps, credit-linked notes, credit spread options, and total return swaps. At that time, credit default swaps were already the main, they already had the largest share of the market, and nowadays it's even more. So credit default swaps account for an even larger share of this pie. So what we are going to do is we're going to focus a lot of our time on this credit derivative, as you'll see in the following notes, and only at the end we will talk a little bit about these other three credit derivatives, right? Okay, so let's start with credit default swaps. Okay. So again, this is the main one, the main credit derivative, and the best way to think about this is really like an insurance policy. And in fact, there are some people that even said that the only reason this was not really called something like insurance, like default insurance, was just because of regulatory reasons, because they did not want to be regulated under the insurance laws. They wanted to be regulated under the other types of banking laws. So that's the only reason why they called it something else than insurance, because this really is just like insurance. Okay, so it works like you see here in this scheme. So you have two counterparties here, the protection buyer and the protection seller. Okay, so the protection buyer, you also call this long swap or selling credit risk, and the protection seller, you call it short swap or buying credit risk. So think of the protection seller like the insurance company. Okay, and this guy here is, for example, a bank that wants to buy protection on some underlying asset. Okay, so this underlying asset, which is not part of the insurance contract, the insurance contract is just between these two counterparties here. This underlying asset is something that is specified on the insurance contract, but it's not part of the contract itself, so it's separate. And you see these dotted lines here because this underlying asset may be on the balance sheet of this protection buyer, or it may not be. It does not. The protection buyer does not have to really own the asset. The protection buyer can establish a CDS with this protection seller without even owning this asset. Okay, so that's why this is dotted. But I mean, usually the standard case, the baseline case that makes this easier to understand is to think of some asset here, like a bond that belongs to some company, some other company that this guy holds, and he's worried about defaulting this bond, so he's going to contract insurance on this bond here. Okay. So this asset may be a specific bond, like I just said, or it may be also something more vague, like borrowed money, meaning that I am insuring not just a specific bond issued by a given corporation, but any any loan or any borrowed money that that company has made. So if that underlying company defaults on anything, that will be enough, that will be considered a credit event that will trigger the insurance contract. Okay? So I am buying insurance on these underlying assets, and then just like an insurance, I pay a premium every 3 months or every 6 months or something like that, which is defined as the amount of the contract that I'm insuring, the notional, times some percentage, some basis points, and I pay this regularly. And then, just like an insurance, this will go on for some time, say 5 years, for example. If nothing happens over those 5 years, that's it. We get to the end, and that's the end. If sometime during this period something happens to this underlying asset, the insurance company pays me a given amount of money, right? So the debt payment can be, more specifically the settlement, can be of two different kinds. So we can have cash settlement or physical settlement. The first one, cash settlement, is, as the name suggests, if there is a default payment, so if there is something here to be paid, it is just a given amount of money, which will be the notional that is insured minus a recovery value, okay, the recovery value of the bond that is specified in the contract. The second alternative, which is physical settlement, then we have two flows going on. So here, if there is physical settlement, there are two things that happen at that default moment. This guy that has the asset delivers the asset to the protection seller, and in return, the protection seller gives back the full face value of that underlying asset. Okay. So notice that this is not equivalent, right? Because I am getting face value, but I'm the protection buyer. I'm getting an amount of money equal to the face value, but what I am sending to the other guy are bonds that have defaulted. So they are not worth face value, they are worth very little, or more specifically, they are worth the recovery value. So, or the recovery rate. So in the net, what's going to happen is I am sending R to that side, I am getting the full face value from that side. So the net amount is again that I am receiving the loss given default. Okay. So both cases, I mean, if everything is correct, both alternatives give you the same amount of money. If you are buying protection and something happens, a default event happens, what you receive is the amount that you lose on the underlying loss given default. Okay. All right, so here is an example of how this is typically used. So let's see how we can use the CDS to hedge credit risk. So the initial trade is we have party A, that is the protection buyer, and B, that is the protection seller in the following CDS. The reference entity is a company, Daimler Chrysler in this case. There is a specific obligation issued by Daimler Chrysler that is specified in the contract. Let's call this bond XYZ. There is a credit event that is specified. Let's say it's failure to pay on that specific bond. And then the insurance contract, the CDS, lasts for 5 years. We write the contract on a notional of $20 million, and we agree that the price, the CDS fee, is 116 basis points, so 1.16%, with semi-annual payments. And then we specify that if something happens, if there is a credit event, then there is physical settlement, right? So how does this work? At the end of each semester, because these are semi-annual payments, we have to pay the fee. So the protection buyer pays to the protection seller the agreed fee, this amount here, divided by 2, because these are semi-annual payments, times the notional of 20 million. Okay, so every 6 months, we pay, A pays to B $116,000, right? Now, suppose that at some point there is a default. So at some point something happens to this underlying asset here. So let's say this happens after 8 months, right? So what do we need to do? Well, since this is in the middle of a coupon period, 6 months, so we are 2 months after the last payment, we need to pay the accrued fee, right? So we were paying an amount of 116 every 6 months, which means that the 2 months that have passed since the last payment are given, represent 2/6 of that fee. So A has to pay to the insurance company this amount of money. Okay. Then at the same time, this is physical settlement. Okay, so now we have two more flows. So physical settlement requires the side A, which was buying insurance, to deliver the actual bonds, the physical bonds, to B, which is the protection seller, right? How many bonds? Well, a notional of 20 million, which was the amount that was defined in the CDS contract, right? And now what the insurance company has to do is it has to pay to A, so B has to pay to A the full notional value, okay? 20 million. Again, we are receiving this amount of money, but we are giving these bonds that are now just worth, say, a recovery rate of 40%, for example, of this amount. So the net outcome, once more, is that A receives the LGD, the loss given default, right? So this is a typical application of CDSs. We can also use CDSs for these other applications that you see here, like reduce concentration risk, create credit investments, hedge trade receivables, and so on. Okay. All right. Another important part of this market are indexes. So in addition to these individual CDSs that we just described, there are also indexes, okay, which are basically just an average of individual CDSs, right? So these are important because just like you have an index for the stock market, which is a single number that captures the broad trend of the market, here you can also capture with these indices the broad trend in credit markets, and you can trade very easily on the overall credit market. Okay, so there are two important families of indices. One is the iTraxx family. Okay, this started in 2004. Basically, this is in the beginning, at least, this was focused on the European market. So the main index in this family is the iTraxx Europe, which has the top 125 European CDSs. Okay. Now, there is a difference between this type of indices and stock market indices. So if you recall, here you have contracts, CDSs, which have a finite maturity. Like in the previous example, a CDS would last for 5 years, okay? Which is not the same as a stock, right? A stock is something that can last for many more years, can last indefinitely. So while the S&P 500 is something that if it weren't for certain events, the S&P 500 or the Dow Jones could be the same index for I don't know, 100 years or something like that. Here, at the end of 5 years, the index would be over because the CDSs would all be at maturity. So to avoid that problem, what people do is actually there is not just one single iTraxx Europe. There are many at each point in time. There are many iTraxx Europe indices alive at the same time. More precisely, every 6 months we create a new iTraxx Europe, where so every 6 months we launch a new series where the 125 names that are on that index may or may not be the same 125 names that were on the previous index. Okay, so for example, This was one series that was created in the Series 5 in 2006. You had there some Portuguese companies, okay? And for sure, some of these companies are no longer in the index today, okay? So again, at each point in time, you have one issue of the index that is the most current one, that is the one that is more heavily traded, but you still have a few iTraxx Europe series that are still alive, that were created some periods ago, right? Another interesting index in this family are these ones that you see here, iTraxx High Volume, and this one, the iTraxx Europe Crossover, which is also important because it measures a different part of the market, which is the sub-investment grade firms, right? So that was the family 1. Family 2 is the CDX family, and whereas the first one was more geared towards Europe, this one, CDX, is more geared towards the US market. So the most important member of this family is this one here, the CDX North America Investment Grade. So it's the twin brother of the iTraxx, but instead of the European market, what you have now is 125 CDSs for North American companies, right? And exactly the same type of scheme of the series. So you can see here in this figure the evolution of these two indices, the iTraxx Europe in green, and then the iTraxx Crossover in red. Right, so this is the CDS premium on investment grade firms in Europe, and this is the CDS premium on sub-investment grade firms. So you can clearly see two spikes here, right? The first spike, the figure is a bit small, but the first spike corresponds to the 2008 crisis, where credit spreads went up a lot, and this second peak here corresponds to the sovereign crisis of 2011, more or less. Okay, so these spreads, these indices are a very fast way to get an idea of the market conditions. Again, just like you can look at the S&P 500 and get a very quick idea of how the stock market is behaving, right? Furthermore, you can also use this for getting exposure to the overall market in a very simple way. That's what this example here shows. So suppose that you are a hedge fund and you believe that the macroeconomic outlook for the euro economy is good. Okay? If it is good, you think that there will not be many defaults, right? If the economy is doing well, firms are doing well, no defaults. So you want to gain exposure to credit risk in that market. What does that mean? You mean you want to work like an insurance company. You want to sell protection because under your view, you will be collecting the premiums from the insurance, but since everything is going to go well, you do not expect to pay any default losses, right? So using this iTraxx Europe, you can very quickly act on that view, right? So in this example, suppose that the fund decides to sell protection on a notional of 10 million euros. And let's say that the iTraxx spread is at 40 basis points. Okay? So how does this work? Very similar to what we have seen before in the single CDS case, but now with a slight adjustment for the fact that this is an index on a portfolio of CDSs and not just on one single CDS. So it works like this. If no credit event happens, right, so if everything goes well, the market maker, so we are trading with the market maker, will pay to us, to Fund A, the fee, the 40 basis points per annum, let's say it's quarterly, on this notional amount, okay? So that's what we are hoping to happen for the next 5 years or whatever period we are thinking about investing here, okay? We just collect the fees and hope for the best. Okay, if we are wrong and defaults start happening, we start to lose some money. So let's say let's compute how much we have to pay in one default, right? So suppose one of the reference entities in the index defaults in year 3. Okay. So how much do we have to pay? So to do this, we just have to note that the index has 125 names in it, so that's the weight of one company, so 0.8%. So what I have to pay to the market maker is that fraction, 8%, of the notional that we contracted. So 0.8% of the 10 million, 80,000 euros. Okay. So now we either pay this with we discussed the different types of settlement. So here we would have physical settlement. The market maker would deliver the actual bonds, and yes, so the market maker would deliver the actual bonds, and I would pay the amount of cash of the total amount of cash in the corresponding to this fraction of the notional, right? So like physical settlement. Okay. So after this, after we settle this default, we continue going forward, but now we have to adjust for the fact that one of the firms dropped out of the index because it defaulted. So after this, we still pay the fee that we agreed in the beginning, the 40 basis points, but we adjust the notional. So instead of a notional of 10 million, we have a smaller notional that subtracts the fraction represented by that firm that disappeared. So we would pay 40 basis points over this 9,920,000 euros instead of 10 million. Okay, and we keep going through time like this, receiving these fees, and if there are more defaults after this, we would pay again the corresponding amount. All right, so I'll stop this video here and continue with CDS pricing on a following video.